We hear the phrase hedge fund everywhere, but what does it actually mean? When we hedge our investments, we reduce or eliminate certain risks that can affect our holdings. Control is the core of hedging itself. A simple example is shorting a stock that you already have a long position in to offset risk. This describes hedge funds' goals well too. Depending on their type, they might focus on protecting investors' funds or producing higher returns. They may use derivatives like options or futures, leverage, short positions, or alternative investments such as crypto or art. Hedge funds are considered an illiquid type of investment. They often require their investors to lock their funds for a period and tend to ask for a few months' notice before someone wants to sell some of their share of the fund. There is a high barrier of entry to them, and they are not offered to the general public but for qualified investors, so institutions or high net worth individuals. Today, these funds usually operate with a 2% management fee and a 20% performance fee. Logically, investors are only willing to pay these high fees if the managers of the fund have been performing well in the previous years or decades. There are four main types of hedge funds. Activist, that's based on corporate actions such as mergers, acquisitions, or restructuring. Relative value, which exploits temporary differences in the price of related securities. Macro, that looks to benefit from changes in the global landscape, and equity, that uses a bottom-up strategy focusing on the securities instead of the macro picture. Most hedge funds start by using a sub-strategy of one of these and evolve in their expertise to be a multi-strategy fund. Their main advantage is that hedge funds typically do well when equity markets are down. Because of the light regulation they are the subject of, they are not required to disclose much information, so it's hard to look into them. You might feel inclined to use hedging in your own portfolio, but just be aware that there is a reason these hedge funds always start with a single strategy, no matter how well educated their managers are. It can be very complex and can result in negative returns. For a simple example, if the market stays the same, you didn't gain anything on neither your short nor your long, but still paid the fee for both. And these fees are usually higher for derivatives. Diversifying into different markets and or sectors is a much simpler and likely better tool to protect your buying power. If you insisted to invest into hedge funds without being an accredited investor, you could look for opportunities in so-called funds of funds. These funds can be publicly available and they invest into multiple mutual funds, exchange-traded funds, or hedge funds to achieve a great extent of diversification. But again, you can buy shares of ETFs and mutual funds yourself without paying the extra fee for the FOF managers. If you like to invest based on facts, I recommend watching the 8th episode, where I answer if it's worth dollar cost averaging. If you'd like to make even more money, check out my Patreon. It's 50% off, but only until November the 7th. Link in the description.